Joining me now to discuss is Alex Frangos, Europe finance editor at the Wall Street Journal. Alex, it's great to see you again. Welcome.
Hey, Kelly, how you doing?
Good. What's the mood over there? Is there a sense that, well, okay, Credit Suisse is Credit Suisse, or is there a little bit of nervousness about how much this could broaden out?
I mean, I think there is still nervousness, maybe a little bit less today because of the Armati appointment. He's someone who people just widely respect. He came into UBS and cleaned things up last decade, and left there a few years ago on a very high note. And he's coming back in to redo that, kind of redo the job all over again of, shrinking an investment bank and focusing this now much larger institution on wealth management. But underneath the surface, shares are up, again today. They're making people feel better. But the prices of in the bond markets are still down. The credit default swaps, which spiked last week, and a lot of people pointed to as maybe the cause or an amplification of concerns about European banks, they're still elevated, and until we still see those come down. I think that's a sign that there are still some jitters out there.
Sure. And, people will say, hey, markets are so thin that one big trade on credit default swaps can move the market for Deutsche Bank. And, yes, that's true. And they're probably less liquid than normal. But you were seeing big reactions to this. Why? Are they justified concerns about Deutsche? Or as we see the market kind of testing the weakness and looking for the next institution that might be on the chopping block, should we just get used to this kind of exercise? Or does it tell us about vulnerabilities that might actually exist in the global banking system?
Yeah, well, I mean, I think the CDS is an easy thing for people to point to and say, oh, this is a very thin market. This is the reason why things are in trouble. But, there are other indicators that people are worried. The prices of the AT1 bonds, which got, the Credit Suisse got wiped out, and that reverberated across the market. Those are down a lot. And that's telling investors that long term, the cost of capital for banks has gone up. So that has people worried, but there is this poking and prodding at, all the, the usual suspects. Deutsche Bank 5 years ago was the Credit Suisse of its time, but it had, a lot longer to go through its reform program, shrink its Wall Street presence, cut jobs, get on a more solid footing. And, what's interesting is, it had that, big fall last week, and I don't want to make any predictions about what's going to happen in the future, but, there were supporters, there were people in the market who came back and said, hey, wait, no, this is a bank that has changed. This is not Credit Suisse, and we're willing to buy its shares. There was a bid there. There was someone there willing to buy it. But, things feel a little bit better the last couple of days. But as, you and I have both lived through crises before, these things go on for a long time. So it's really hard to call the all clear.
This is unfair but I can't see you and not ask about commercial real estate. I mean, you're over there now. There's plenty of crises over there maybe to worry about. And back here, we're all kind of pulling out the playbooks and saying, okay, who has commercial real estate exposure, especially on the office front? I mean, I don't know if you want to just offer any sort of observation, having lived through that episode in 2008.
Yeah, well, I mean, it's Deutsche Bank again, still, just despite what you'd think, still has a pretty large exposure to commercial real estate in the U.S. They were obviously a very big player before the crisis. But, the exposures are different. And, people say there's a little bit, there's a lot more equity in the system. But again, the world has changed in a way, what happened in 2008 was different. It was, it was an overbuilding crisis. There's just too much supply and there had been too much credit. This time it might be, it's a demand problem. It's, the world has changed because of COVID. Nobody's going back to the office. And in fact, people are going back to the office less in the U.S. than in Europe. So arguably, commercial real estate in Europe might be not quite as bad. But again, it's the things have changed in the U.S. And it's just something, people have been flagging for a couple of years. And now those leases are starting to roll. And, landlords are, having a bit of trouble.
Yeah, no, it's as with so many people lately, Alex, it's both great to see you again and somewhat worrying because you go, okay, we're going through one of these periods again. Thanks for your time this evening. We appreciate it very much.